Hello, everyone. Welcome to MSS Mentorship and Online Classes. I am Mohamed Sheikh Sisi, your tutor and your mentor. Today, we are going to cover IAS 36, Impairment of Assets. We are going to look at the objective and scope of IAS 16, which is very much important. And basically, when we're talking about impairment, it means if an asset is not providing the required economic resources from the utilization of that particular asset, then we can say that asset has been impaired. This is a simple thing you need to know. For instance, if the asset, operational activities to ensure that they produce 10,000 units of X product, then eventually the machine or the asset can't able to produce 10,000 units. Let's assume it can produce 9,000 or 9,500 units of product X. So it means the asset cannot able to meet the required economic resources from the utilization of the asset. So it means that particular asset has been impaired. So this is the concept, and this is the reason why we are going to do an impairment review to ensure that we keep our assets updated in the financial statement. So also we are going to look at the scope of IAS 36. We are going to look at standards, that we are not going to apply the IAS 36. Also, we are going to look at the key definition, the carrying amount, the recoverable amount, value in use, fair value less cost to sell, and the cash generating units. Also, we are going to look at the indicators of impairment, both external and internal indicator, and we are going to look at how we can impair the asset within the cash generating unit and how we can allocate and apportion the various impairments to the cash generating unit. Also, we are going to show and we are going to look at how we can calculate the recoverable amount, which can be from the either of the fair value less cost to sell or the value in use. Also, we are going to look at how we can account, how we can treat, and how we can include the impairment loss within the financial statement for both individual and the cash generating units. And finally, we are going to cover how we can account for the reversal of an impairment. Very important concept that we need to know. So now we are going to look at the scope and objective of IAS 36, which is to ensure that the asset carrying value is not more than the recoverable amount. Very simple. When the carrying value of an asset is greater than the recoverable amount, it means the asset has been impaired. So we need to reduce the carrying value of the asset to the recoverable amount. And that difference between the carrying value of the asset and the recoverable amount is what we refer to as the impairment. So very important point that we need to know so that we can able to understand throughout this session. So the scope of IAS 36 applies to most assets held by an entity. For example, the property, plant and equipment as per IAS 16 and the intangible assets or the IAS 38. For other assets like IAS 2 inventory, inventory can be valued at the lower, of course, on the NRV. So by default, the valuation of inventory, it encompasses the concept of impairment. Also, we are going to look at the assets arising from construction contract as per IAS 11. We are going to look at deferred tax later in the session, and we are going to look at the assets arising from the employee benefits as per IAS 19. This, we are going to deal with it under the strategic business reporting paper. Also, we are going to look at IFRS 9, the financial aspect. It has its own, impairment, setup and approach that IFRS 9 required us to use. Finally, we are going to look at the IFRS 5, which is the non-current asset held for sale and discontinued operation, how they can account for their own impairment. So we can only use IAS 36 for property, plant and equipment and intangible assets. So we are going to look at key definitions, the carrying amount, which is the value after we have deducted the accumulated depreciation or amortization or any accumulated impairment losses. The outstanding balance is what we refer to as the carrying amount. The remaining balance is what we refer to as the carrying amount. So now, if we are talking about the recoverable amount, the recoverable amount is the higher of the fair value less cost to sell and the value in use. So we can either use the fair value less cost to sell or the value in use. Which one is higher is what we are going to use. Now, when you're talking about fair value less cost to sell, this is the amount between the sales assets within an arm's length transaction between knowledgeable, willing parties, less the cost of disposal. When we are going to look at IFRS 13, the fair value measurement, we are going to look at the definition of fair value. But for now, we can keep it simple. We are going to look at the arm's length transaction, that value, we are going to use. Then we are going to deduct the cost to sell. So the difference will be the fair value less cost to sell. And when you're talking about the value in use, if we are going to use the asset, the future cash flows, expected to derive from the assets or the cash generating usage, we are going to discount it to present value. So that present value, we need to compare it. We need to use it as a recoverable amount if it is greater than the fair value less cost to sell. So when we're talking about impairment losses, the difference between the carrying amount and the recoverable amount. If the carrying amount is greater than the recoverable amount, but if the recoverable amount is greater than the carrying amount, it's fine. There is no impairment. So also, we are going to look at the cash generating unit, which is the smallest identified group of assets that generate the cash inflows independently of those from other assets or the group of assets. So now we are going to look at the concept of impairment for individual assets. As I already mentioned earlier, when we're talking about impairment, we are going to compare the whole about impairment. We are going to compare the carrying value of an asset to its recoverable amount. If the carrying value of the asset is greater than the recoverable amount, it means we are going to impair the asset. We are going to reduce the value of the asset to the recoverable amount. This is the takeaway point you need to know. And the recoverable amount can either be the higher of the fair value less cost to sell or the value in use, either of the two. So we can only consider a figure to be the recoverable amount if it is the fair value less cost to sell or the value in use. The higher of the two is what we are going to compare with the carrying value to determine whether there is an impairment or not. So now we can look at illustration one, simple and straightforward. The first portion requires us to identify the recoverable amount, and then we can look at the net realizable value and the value in use. For asset A, 110 as the net realizable value, which is the fair value less cost to sell, and the value in use is 120. So it means we are going to use 120 as the recoverable amount. Simple, because it is the higher of the fair value less cost to sell and the value in use. Also for asset B, the net realizable value is 125 and the value in use is 130. So we are going to use 130 as the recoverable amount. For asset C, we are going to use 100 because it is greater than the value in use. So now we are going to calculate our impairment. For asset A, the carrying amount is 100 and the recoverable amount, which is the value in use, is 120. The carrying amount is less than the recoverable amount. So there is no impairment. Simple, there is no impairment. We can only get impairment if the carrying amount is greater than the recoverable amount. Now for asset B, the carrying amount is 150. The recoverable amount, which is the value in use, is 130, which is less than the carrying amount. So the difference of 20 will be treated as an impairment. For asset C, 120 should be compared with 100. So a difference of 20 also should be accounted for as an impairment in the statement of financial position and as well as the statement of profit and loss. Very good, very good, very good. So now we are going to look at indicators of impairment and when we are going to test for impairment. If you can remember, when I talked about IAS 38 intangible assets under the 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 research and development approach, for intangible assets with an indefinite useful life should be tested annually for impairments, as well as we are not going to calculate any amortization on that particular intangible asset. So we have three categories of assets which we are not going to wait for indicators of impairment, because on normal practice, before we are going to consider to impair any asset, there should be an assessment, a review of the impairment indications. We need to do that review. But we have certain categories of assets that we are not going to wait for short, indications of impairment. For instance, if we're talking about intangible assets with indefinite useful life, goodwill acquired in a business combination. I'm not talking about internally generated goodwill. I am talking about the goodwill that is acquired under business combination as per IFRS 3. Or if we are talking about intangible assets not yet available for use, these three categories of assets should be tested annually, at least annually, for impairment, regardless of whether there's an indication of impairment or not. Whether there's an indicator of impairment or not, we should test these particular categories of assets at least annually for impairment. Key concept that you need to know, it is mostly tested in the examination. So you need to note it down. You need to know the three categories of assets, and you need to know the reason why are we not going to wait for indicators of impairment. We need to test it, whether there's an indicator or not. For all other assets, other than these three categories stated above, an impairment test is required only when there is an indication that the asset might be impaired. Very crystal clear and very straightforward. So now we are going to look at the indicators of impairment. We have two broad categories. We have the external sources and we have the internal sources. So when we talk about the external sources, it can be the market value of the asset has declined significantly, which is fine. And if we can talk about the significant changes in the adverse effect on technology, for instance, now the world is moving to more of artificial intelligence, the AI. We are moving to more of big data, to data analytics, and to more systemized approach to account for our day-to-day operational activities. So we have lots of technological compliance, we have lots of market, economic, and legal environment that might change, that will affect, the business adversely. So that effect should be considered to be an indicator of an impairment. So this is an external source. Also, we are going to look at the increase in market interest rate, other market rates, or the reduce in the recoverable amount. We are going to look for these guys as they can be an external indicators of impairment. So also we are going to look at internal indicators, for instance, physical damage, accident. Also, we are going to look at the way an asset is being used has changed. For instance, I mentioned earlier that the machine is used to produce 10,000, packets of X products, but now it can only produce 9,000 of X products. So it means the machine cannot meet the required, production capacity. So we need to do an impairment review on this particular machine so that we can reduce the value to the machine, the value of the machine to the quantity that the machine can produce. So the economic benefit can match with the value stated in the financial statement. We need to see this relationship, this linear relationship between the economic resources that we are going to receive from the utilization of the assets as to the carrying value of the assets. Internally reporting indicating that the economic performance of an asset is or will be worse than expected, as I mentioned. So now, very good. We are going to look at the recognition and measurement of impairment. Where there is an indication of impairment, an impairment review should be carried out. When there is an indicator of impairment, automatically we need to carry out an impairment review. Carrying out an impairment review means we need to calculate the recoverable amount. We need to ensure that the asset should be written down to its recoverable amount. Then the impairment loss should be immediately recognized in the statement of profit or loss as an expenses. So the double entry for impairment, we are going to debit expenses and we are going to credit the value of the asset. So we can reduce the carrying value of the asset to its recoverable amount. So now, why are we going to recognize the impairment loss immediately? go and review your prudence concept. We are going to account for gain immediately. For loss immediately. Wise for gain, we are only going to account for gain if it is, crystallized. That at that point in time, we are going to account for the gain. But for loss, we are going to account for it immediately. Now, we have an exception to this accounting treatment. For instance, in a situation where the asset has been previously revalued, then we have a gain in the revaluation that is seated in the revaluation reserve, and that particular asset has impaired. So therefore, how are we going to do to ensure we resolve the impact of the amount seated in the revaluation reserve and that of the impairment loss that we are going to recognize? It means we are first going to offset the revaluation, the impairment from the revaluation reserve. Then, if there's any outstanding impairment that is remaining, we are going to account for it automatically as an expenses. We have an example that we are going to look at so we can able to understand. But this is the concept. I can remember when I covered IAS 16, the revaluation gain and revaluation loss, we talked about how we can account for a revaluation loss in a previous revalued asset. So this is the same concept and principle that we need to implement in ensuring we account for the impairment when there is a revaluation, already existing revaluation value in the reserve. So now let's look at the concept of the recoverable amount. Now looking at the value in use, which is 100, and looking at the fair value less cost to sell of 300, the question stated that identify the recoverable amount of the car and any impairments required, which is very clear. And from the question, the value in use is 1,000, sorry. However, the car is a classic and there is a damage for the part. This results in the fair value less cost to sell of 3,000. The opening kind amount was 8,000. So simple. We need to keep it short and simple, right? We need to compare for the recoverable amount. We need to compare the kind value less cost to sell. So the fair value less cost to sell and the value in use. So we are going to use the higher of the two to account for the recoverable amount. So the recoverable amount in this question will be the $3,000 because it is greater than the value in use. So now for the impairment, we are going to compare the 8,000. Let's keep it simple. Let's ignore the 8 years mentioned about, because there's no specific indication of about the impairment, the depreciation period. So let's keep it simple. So what you need to understand is which figure are we going to use as recoverable amount and how are we going to calculate our impairment. So the impairment will be the difference between the 8,000, the car in value, and the recoverable amount of 3,000 yuans. So this is the solution to the question. So now let's understand this second example, which is very much important for us to know. An entity owns a property that was revalued to $500,000 on 31st March 2016 with a revaluation gain of $200,000 being recognized as other comprehensive income and recorded in the revaluation surplus. At 31st March 20x5, the property had a carrying amount of 460 at 31st March 20x5. But the recoverable amount of the property was estimated at only 200,000. So now we need to understand something. Before the asset, had previously been revalued, and a gain of 200,000 yuans is currently in the revaluation reserve. Then at the same time, the asset is currently been impaired, right? The property had a carrying value of 460, which is the carrying value after depreciation. So now the recoverable amount is 200. So there is an impairment of 460 minus 200. So we have an impairment of 260. Look at this here. So now how are we going to account for this impairment of 260? According to IAS 36, it clearly and explicitly stated that the impairment loss, when there is a revaluation reserve, when there is amount seated in the revaluation reserve, we need to offset the impairment loss first against the revaluation reserve. Then if there is any remaining impairment, we are going to show it as an expenses. So currently we have a credit figure in the evaluation reserve of 200,000 and the impairment is 260. So what we are going to do, we are going to debit 200 in the evaluation reserve so we can offset it. So it means we still have outstanding impairment of 60. So that outstanding impairment, we are going to debit expenses. So this is what we are going to do. And this is how we are going to solve this particular question. So now we are going to look at the reversal of impairment loss, how we can, reverse an impairment loss. Very important concept we need to know. External indicators of impairment reversals are increase in the asset market value, favorable changes in technology, market, economic and legal environment, decrease in interest rate, favorable changes in the use of assets, improvement in asset economic performance. Now, the calculation of impairment losses is based on predictions of what may happen in the future. It is clear. Sometimes actual events turn out to be better than predicted. If this happens, the recoverable amount is recalculated and the previous write down is reversed. Simple and clear. Impaired assets should be reviewed at each impaired asset should be reviewed. Any asset that has impaired should be reviewed at each year, at each reporting date to see whether there are indication that the impairment has reversed. A reversal of impairment losses is recognized immediately as income if we are going to reverse it in this profit or loss. If the original impairment was charged against the revaluation surplus, it's recognized as other comprehensive income and credited to the evaluation reserve. Simple to correct the situation. The reversal must not take the value of the asset above. Very, very important concept for you to know. So all of these bullet points you need to know it as it will be tested in the examination hall within the multiple choice questions. Very clear point you need to know. Hmm? The reversal the reversal must not take the value of the asset above its depreciated historical cost. The amount it will have been if the original impairment had never been recorded. So that's what we are going to do. Because we are not expecting the reversal of impairment to result in a gain in the impairment. It's not a revaluation. So that means when we are going to reverse an impaired asset, the impairment, should only be limited to the depreciated historical cost. We are not going to state the asset above the historical depreciated cost. The amount will have been if the original impairment had never been recorded. The depreciation that would have been charged in the meantime must be taken into account. The depreciation charge for the future periods should be reversed to reflect the change in carrying amount. Everything we need to reverse it. An impairment loss recognized for goodwill. Very important point. An impairment loss recognized for goodwill cannot be reversed in a subsequent period. The reason for this is that once purchased goodwill has been impaired, any subsequent increase in the recoverable amount is likely to be an increase in internally generated goodwill. And according to IAS 38, the intangible asset, for internally generated goodwill, we are not going to account for it as an intangible asset because we can't able to segregate, we can't able to distinguish the cost of the internally generated goodwill with the cost of running, the business. So this is crystal clear, and we need to note it down as well. So for reversal of impairment, these are the points that you need to know. And so now we are going to look at the cash generating units. One of the key area that you need to focus because in most examination, this area will be tested regularly and especially in the multiple choice questions. So you need to know this particular point. So now, when we're talking about the cash generating units, it's the smallest identified group of assets that generates inflows that are largely independent of the cash flow from other assets. So now when assessing the impairment of assets, it will not always be possible to base the impairment review on individual assets. The value in use calculated may be impossible on a single asset because the individual asset does not generate distinguishable cash flows. In this case, the impairment calculation should be based on the CGU, the cash generating unit. So now, this is very simple. So you can remember for individual, we are going to compare the carrying value of the assets with the recoverable amount. So when it comes to the cash generating unit, we are going to compare the carrying value of the cash generating unit, not the individual assets again. The carrying value of the cash generating unit with the recoverable amount of the cash generating unit. We are going to compare like with like. Cash generating unit um, carrying value and cash generating unit recoverable amount. So therefore, if the carrying value is greater than the recoverable amount within the cash generating unit, then the cash generating unit has been impaired. So we need to account for the impairments. So now, the key concept that you need to know according to IAS 36, which is very much important for the cash generating unit. Now, after we have identified that there is an impairment, we need to know how we can allocate and apportion this impairment to the various assets within the cash generating unit. First condition clearly stated that for a purchase goodwill under the business combination, we need to allocate the impairment 100% to purchase goodwill. First condition that we need to know. Always for purchase goodwill, we need to allocate 100%. Second condition, for specific assets, the question might, tell you that this particular asset has fully impaired or this portion of this asset has impaired. So any specific asset that is mentioned in the question, we need to treat it separately and with caution. When we are going to solve the question, we can understand exactly what I'm saying. Then the other assets, including other intangible, you know, in the cash generating unit, we are going to allocate the impairment based on the carrying value. We are going to prorate the impairment based on the carrying value. When we are going to solve, we can able to understand. Note, note, note. No individual asset should be written down below its recoverable amount. We are not going to write the asset down below its recoverable amount. No. At least the asset value should be equal to the recoverable amount. This means that unless specifically impaired, if the asset is specifically impaired, current assets are unlikely to be impaired as part of the cash generating unit. Now, for current assets, inventory, receivables, short-term investments, they are unlikely to be impaired unless if the question specifically stated that the inventory has impaired. However, on normal ground, it should have been accounted for under IAS 2, the scope of IAS 2. So now let's look at this example so we can able to understand exactly what I'm saying, right? Let me um, remove this. Oh, sorry, not what I have done. Okay. So now, look at the question, right? Shellco runs a unit that suffers a massive drop in income due to the failure of its technology on 1st January. Wow. So if the technology fails, it means there's an indication of impairment. And it means the technology has fully impaired 100%. So this is a specific indication. The following carrying amounts were recorded in the books immediately prior to the impairment: goodwill, and technology, brands, land, building, and other assets. The recoverable value of the unit is estimated at 85. The technology is worthless. It's worthless. So zero value. We are going to charge 100% impairment to the technology. This is what the question clearly stated. Following its complete failure, the other assets include inventory and receivable. It is considered that the kind amount of the other assets of the other net assets is reasonable representation of their net realizable value. So it means there are 40 for other assets. We are not going to allocate any impairment to them because they are assumed to be stated at the recoverable amount. So now let's solve this question, right? So we can able to understand better. So first of all, we need to calculate total value of the assets, total assets in the CGU, which is 20 plus 5 plus 10 plus 50 plus 30 plus 40. Where is my calculator? Yay. 20 plus 5 plus 10 plus 50 plus 30 plus 40. A total asset of 155, which is clear, right? And then the recoverable amount is given in the question. Recoverable amount, which is 85 million. So it means the impairment is the difference between these two guys, which is 70 million. But now, the question clearly stated, let's look at the allocation of impairment, right? Very simple. We are going to allocate the impairment. Allocation of impairment. Under the allocation, we are going to look at the asset, right? We're going to look at the asset. We are going to look at the carrying value. We are going to look at the impairment, and we are going to look at the value remain. So for goodwill, 100% impairment as per IAS 36 goodwill. The value of the goodwill is 20. So we are going to allocate 100% impairment minus 20. So it remains 0. Right? Technology. Also 100% impairment on technology because it is worthless. So minus 5. So out of the 70, we have utilized 70 minus 25, so it remains 45, right? So from the 45, the other assets, we are not going to impair it as stated in the question because it is assumed to be at the recoverable amount. So other net assets, we are not going to impair it, which is, what is the value for other net assets? Which is 40. So you are not going to calculate any impairment, 0, right? So this value will be 40. So now we are going to look at brand, land and building, 10, 50, and 30. Brand, land, building. The values are 10, 50, and 30, respectively. 10, 50, and 30. So now the standard is telling us that we need to prorate the impairment, the remaining impairment for these guys. So we are going to take the total value. So now for this, it means we are going to take 10, which is the brand value, the kind amount, divide by the total impairment, by the total value of the asset that we need to allocate the impairment for. So now let me do working. Total value that will allocate the impairment to the impairment, which equals to and 10 the brand plus 50 the land plus the building 30. So these three guys, we are going to do a separate treatment for them. We are going to prorate the impairment um, based on the carrying value. So we take for brand. So brand, we are going to use 10 divide by the total 50 plus 30, 80 plus 90 times the impairment that remains, which is 45. So 10 divided by 90 times 45, we have 5. So 5. So we are going to do the same for land, which will equals to the value for land is 50 divided by 90 times the impairment, which is 45. 50 divided by 90 times 45, the impairment is 25. Hope we know where the 45 comes from, right? So therefore, we talk about the building. The building equals to 30 divided by 90 times 45. So 30 divided by 90 times 45. So 15. So 15. So now we can say working, 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 working. So working. So now we can allocate out of the 10, 5 impairment. It remains 5. Out of the 50, the impairment is 25 minus 25. It remains 25 and 25. And out of the 30, the impairment is 15 minus 15, and it remains 15. So this is how we can account for the impairment, how we can allocate the impairment for the cash generating unit. Very important concept you need to know. I'm going to revise it again. Firstly, we are going to charge 100% of the goodwill. We are going to impair all of the value of the goodwill. Secondly, if there is any specific assets that the question clearly stated. For instance, this question mentioned about technology. So the technology is worthless. It means it has no future economic benefits anymore. So we are going to fully impair that particular asset. Then also the question talks about other assets as they are assumed to be at their recoverable amount. So we are not going to calculate any impairment for them. That's why we include 0 under the impairment calculation. Then as per AS 36, all other assets, we need to prorate it based on the carrying value. So we took the carrying value of 10, 50, and 30, the total of 8, then we calculate based on the carrying value. So this is the concept that we need to know about the cash generated unit. So now we are going to look at another example, which is an objective. You can solve it on your own. I'm just going to extract the key points for you to understand. A division of an entity has the following balances in its financial statements: goodwill, plant, building, intangibles, other assets. Following a period of losses, the recoverable amount of the division is deemed to be 4 million recoverable amount. So for calculating impairment, we need to compare the recoverable amount and the carrying amount. Now let's look at the requirements. So the nearest 1,000, what is the balance on the building only for the building following the impairment? So we don't care about goodwill, plant, intangibles, and other assets. But before we can solve for goodwill, we need to solve for all, because part of the impairment we need to allocate 100% to the goodwill. Any outstanding impairment, any remaining impairment, we need to look for any specific assets, which I think the question did not mention about it. And the recent valuation of the building showed that the building has a market value of 2.5, which is fine. That is not our problem, right? The other assets are the recoverable amount. The entity uses the cost model for value the building at this. So it's very simple. To compare it, then we need to allocate the impairment as per the IAS 36, consider goodwill, specific assets, and any other assets. It's obviously say the question is silence about the other net assets, so we are not going to allocate any impairment to other net assets. So this is there. explanation, then you can solve it, then you can have the answer. So now we are going to look at implication for um internal auditor and finance manager. This more has to do with for the strategic business reporting student to know the financial impact, and as well as internal auditor and finance manager. Ensure management as appropriate process to identify indicators of impairment at each reporting date, which is very clear. And for indefinite life intangible asset, ensure annual testing is scheduled. We need to do a schedule to ensure we conduct annual testing for these three categories of assets. We need to check our assumptions for the value in use. We need to look at the cash flow and the discount rate we are going to use to calculate the value in use. And also, we need to ensure that the fair value is at the arm's length transaction as per IFRS 13, and also we need to deduct the reasonable cost to sell. And ensuring within the cash generating unit, we identify the appropriate and we allocate the impairment. Then finally, we need to review the disclosure for completeness and transparency. Also, as an auditor, you need to challenge the management assumption, judgment, and estimates, because by default they are inherently, risky, and they might, impact the audit exercise. So for IAS 36 impairment, so far, this is all what you need to know. So when we are going to conduct the live online session, we are going to look at these cheat questions. I'm just going to browse through it so you can see the easiest way to solve it. Now, for question 2, a vehicle was involved in an accident exactly halfway through the year. Halfway through the year, the vehicle cost 10,000, right? And the remaining life is 10 years at the start of the year. So it means we need to account for our depreciation. Following the accident, the expected present value of the cash flow associated with the vehicle was 3,400, and the fair value, let's suppose to say 6,500. The question is, what is the recoverable amount of the vehicle following the incident? Simple. The recoverable amount of the vehicle. So you can either take the 3,400 or the 6,500. Which one you want to take? When we are going to solve a live online session, I'm going to show you which one I'm going to take. So you are going to do the same. So also we are going to look at this cash generating unit, very important. And let's look at the question. What will be the value of F property, plant and equipment after the allocation of impairment loss? After the allocation of impairment loss. After the allocation of impairment loss. We have property, plant and equipment, 200, allocated goodwill, 50, product patent, net asset at net realizable value. As a result of adverse publicity, F had a recoverable amount of only 200. So it's very simple. So the standard tells us that we need to allocate the impairments to goodwill. So firstly, we need to calculate the impairment, because the recoverable amount is 200, then the carrying value is 300. So the impairment is 100. So we need to allocate 50 to goodwill, 100%. Then the remaining 50, we are not going to allocate anything to net asset because it is stated as the net realizable value. So the remaining assets are the property, plant and equipment, and the product patent. So we are going to prorate, we are going to allocate the impairment based on the carrying value. So we are going to take, for the property, plant and equipment plus the product patent, it will give us 220. So we are going to take 200 divided by 220 times the remaining impairment, which is 50. Then we need to allocate that amount to the property. Then we do the same for the product. Then therefore we calculate the carrying value of the asset after the impairment. So we need to add all of these assets, then it can give us the answer among the options that is given in the question. Also, question 4, which of the following is not an indicator of an impairment? Question 5, we are going to look at how we can calculate the value of plant in the M statement of financial position. So this is all what we are going to do. So during the live online session, you need to ensure you present and you attend the live online session. So thank you very much for your time.